Good afternoon, I'm Mario Becker from Das Family Office. In the following video, I'm discussing the 2025 market developments. I hope you're finding this useful. Well, 2025 felt very dynamic if you ask me, and that's probably because we're now living in Trump 2.0. That means we have witnessed the first year of the second presidency of Donald Trump. And as in his first presidency, everything has been pretty dynamic, a lot of announcements pretty much daily, some of which have major impacts on global financial markets. Obviously not everything, but some is truly relevant for financial markets, which is why we need to monitor things. I think the most important announcement of 2025 was the so-called Liberation Day on April 2nd, where Donald Trump presented the world in the Rose Garden of the White House exorbitantly high tariff rates for friends and foes. And the world was wondering what had happened because, yes, he was announcing himself as a tariff man, but the numbers that he announced were outrageous and didn't make sense from many perspectives. Markets were, I think, honestly confused and sold off dramatically. And this was a big surprise. Also for me, I honestly have to tell you, many people wanted Trump back in the seat because he liked to be benchmarked against the S&P 500. He was typically perceived as somebody who would be beneficial for the US economy and US stock markets. So there was effectively a bit of a rally in the run-up to his presidency. But in April, this announcement really looked very much like Donald Trump wasn't the capitalist anymore that we had gotten used to, but rather a demagogue who had a different agenda. And I think that confused people. And that's, I think, definitely a reason why markets sold off the way they sold off. But luckily, over the weekend, I remember I was in Munich actually. Well, he backtracked on many of these announcements. He announced a moratorium of the tariffs vis-a-vis China, and markets recovered very quickly. And in hindsight, April looked like a fantastic buying opportunity because pretty much until the end of the year, markets were good. All asset classes, with very few exceptions, did well. What didn't do well was actually the US dollar. The dollar also sold off in April, but continued to be weak. Especially, I mean, if we measure it by the DXY index, which is mostly measuring the dollar against the euro and the Japanese yen. So measured by this index, the dollar lost about 15% against the euro, which was very different from the expectations at the beginning of the year, where people felt that the euro may have another weak year, but it didn't. It becomes quite clear that the US dollar is effectively the outlet for all the decisions that are taken in the US. So people are now talking about a rebalancing away from the US dollar, readjustment. So whilst everything looks pretty beautiful in US dollar, for US dollar investors, S&P 500 was up almost 20%, even NASDAQ, despite all the challenges towards the end of the year, was also up almost 20%. But if you calculated your performance in euro, what was 20% actually became roughly 5%. Very different. Also, holders of Singapore dollars, which is important to us in some of the other currencies, also saw softer performance if measured in their home currencies. We don't expect this to change because the dynamics that kind of triggered this weaker US dollar are still very much in place. US indebtedness is very high. It's very hard to fathom how especially long-dated debt could be paid back. And what was also unusual in 2025 is the fact that despite the fact that the ECB cut interest rates and also the Fed cut in the second half of the year, long-dated bonds actually sold off. This is something that was maybe historic to a certain degree, because normally if central banks are cutting interest rates, the whole yield curve moves down, benefits pretty much every part of the yield curve. But we didn't see that this time around. We didn't see it in Europe. We didn't see it in the US. And that shows that there's a lot of doubts out there as regards the capacity of the governments to pay back their debt without the help of the central bank. It has to be assumed that at some point at certain interest rates on the long end, the central banks will have to come in the picture, buy that debt, similar to what we've seen in Japan. In addition, there's this discussion, which is widely called the Mar-a-Lago Accord, where there have been discussions whether or not foreign holders of US debt should pay taxes, or whether the debt held by foreign investors should be restructured and converted into long-dated bonds. And these are obviously concerning discussions. So from the perspective of a global asset allocator, you have to be very careful, and you have to look for alternatives. The beneficiaries of this discussion are currencies of countries that kind of have their house in order. That would be, from my perspective, countries like Switzerland and also Singapore. But the biggest beneficiary in 2025 was actually gold and other precious metals, to the point where towards the end of the year we can almost speak of a silver hysteria. So I'm not sure where we actually stand in this long-term development, whether this was a price explosion that will soften in 2026, or whether we really see a totally new dynamic, as some of these long-dated gold bugs are proclaiming. We have to see what that means for us. But surely there's a lot of doubt around the US dollar, and there are too few liquid alternatives. The euro isn't perceived as a strong alternative, and neither is the Japanese yen, which actually didn't benefit from the weak dollar in 2025. And countries such as Canada, Australia, Norway, Sweden, they're just too small. They cannot absorb the rest. What couldn't benefit was actually Bitcoin. Not that we're very much involved in Bitcoin, we're not. But naturally, we're following the market, and we have a few clients that are interested in Bitcoin. And we would have normally expected that Bitcoin should do well in an environment where the US dollar doesn't do well, and especially also where you have a president who's promoting crypto investments. But it didn't work. We're wondering why. Naturally, we're observers. It sounds like some of the so-called whales, long-term holders of Bitcoin, have been liquefying their holdings via the launch of the many ETFs. But clearly, I think it's right to say that Bitcoin is not the digital gold that people were talking about. It looks like gold is gold. That means there's demand for gold from central banks, very credible institutions, and obviously investors who want to diversify away from the US dollar. But Bitcoin doesn't seem to be a choice of this audience. As mentioned, global equity markets had a very good year. If we look at the MSCI World Index, the S&P 500, NASDAQ 100 Index, in US dollar, they gained towards 20% and more. But what was different last year was the fact that international markets, for the first time in many years, outperformed the US market. So Europe did very well, Asia did very well, and emerging markets did very well. Even China, which has been a laggard in many years, has done pretty well. There were very few laggards, so it's quite remarkable that we effectively could witness a third year of very high double-digit gains in global equity markets, which is very unusual, because in the long term we're expecting 6 to 8, or in certain cases small mid-cap 7 to 10% per year. So 3 years of double-digit returns are exceptional, and this makes you wonder whether this can continue or not. We'll talk about this a bit later. Markets that didn't do well were US small and medium-sized companies. That was quite remarkable. Despite the fact that the Fed was cutting rates, they didn't do so well. Internationally, small and medium-sized companies did really well. If you know me, you know that I have a soft spot for small caps, and they did really well outside the US. What also didn't work last year were REITs, and also the shares of private equity companies. You've probably followed the discussion around private credit and the cockroach discussion, which Jamie Dimon triggered. But you have to take into consideration that they did really well in the run-up to last year. The healthcare sector did badly. Indian and Argentinian shares did badly. But all of those had their reasons. You could argue that Indian shares were quite expensive at the beginning of the year and they needed to take a breather. Same for Argentinian shares, I may say. The healthcare sector is suffering from the fact that the US government wants to cut prices on medications and on healthcare treatments and all. This is why investors are holding back with investments. I remember that in the mid-90s, the Clinton administration was trying the same, and markets, or the market for healthcare stocks, was quite depressed at the time. But if you're looking at healthcare in the long term, you will see that this sector tends to be very profitable, and investing in it for the long term is very good. So maybe this could be an area for 2026. What's also important, because we tend to also look at factor investing. That means we're looking at the world equity market and see how companies do by looking at certain factors. And the main factors are typically the quality of a company. That means, is it a highly profitable company with low indebtedness? The size of a company, is it a small company or is it a large company? We're looking at the so-called value factor. Is a stock cheaply valued or is it expensive? Then we're looking at the momentum factor. That means stocks that have been purchased recently tend to do well in the foreseeable future. And if they've gone down, they tend to go down further. And lastly, the multi-factor. That means an equal distribution of the factors value, size, quality, and momentum. And looking at these factors, we can clearly say that the value factor succeeded last year. Value indices, as measured by the MSCI World Value Index, have done really, really well. Much, much better than the regular MSCI World Index. And I think the reason for that is the fact that these shares were quite cheap at the beginning of the year. And this index only contains about 50% US stocks. That means investors could benefit from low valuations as well as better currency movements. What did badly was the quality factor. And again, as you know me, you know I like the quality factor. I'm a fan of Warren Buffett. I like to buy companies with big moats, with high profitability, with great brands and everything. But unfortunately, this didn't do well last year. And I think the reason for that is the fact that they were quite expensive at the beginning of the year. And we've kind of also warned that investing in those at the beginning of last year was probably a bit expensive. And on top of that, the MSCI World Quality Index holds about 70% US stocks. So buying this index also meant that you had a significant exposure to US dollar. And if you converted that back into euro or Singapore dollar, this didn't look as great anymore. But things can change. We know that in the long run, all factors tend to outperform the broad index. So don't throw in the towel if you've been long the quality factor. 2026 is another year, another opportunity. Valuations have adjusted. Don't give up if you hold quality stocks. If we're looking at the global bond market, we can actually observe the fact that all relevant central banks had, or let's say ECB and Fed are clearly on a interest rate reduction mode, even if the ECB may have come to a pause now, but they cut interest rates in 2025, and there seems to be limited expectations that they would raise interest rates, but they indicated they may not cut further. The Fed, on the other side, is clearly in cutting mode, and on top of that, we have a lot of pressure of the US government on the Fed, and the fact that there will be a new Fed president next year shows that, we can probably expect further Fed cuts. In Japan, it's different. Japan has been raising interest rates, and they've been signaling that they will continue to raise rates. This is quite different from recent history where Japan was really holding on to the zero interest rate policy. What we've seen last year is that on the short end of capital market rates, bonds have done very well. They've been rising in prices. But on the long end, we could see either stability or we've been seeing small losses. And in Europe, the losses have been a bit bigger because long-dated bonds, especially in Germany, the interest rates on these have gone up quite a bit. If you're looking at rates, the return in the year was pretty good on the short end in money market. It's been okay for bonds with normal duration, but it's been disappointing for bonds with long duration. And now that the 30-year US Treasury is at about 4.8% and the 30-year German Bund is at about 3.8%, we probably have to wonder if this is enough, if these are interest rate levels where buyers will come in. But it's also clear yet, and if we're looking at the amount of long-dated debt that the US Treasury is issuing, we can probably conclude that we're not there yet. As far as Japan is concerned, Interest rates have also been rising at the long end. And the interest rate differential between Japan, Europe, and the US is now pretty small, or much smaller than what we're used to. This is probably also the reason why we can assume that the dollar will not go really strong, because Japanese investors now have choices. They can keep the money in Japan or repatriate some of it. So if the Fed were to cut too much and US interest rates were to come down too much, that may put quite a bit more pressure on the US dollar. But we will see. The segments that did really, really well in fixed income were emerging market fixed income in hard currency and local currency. Tier 1 capital had a good year. High yield bonds had a good year. So all the specialty bonds that our income-seeking investors are aiming to buy, they did really, really well and had a great year. As mentioned, global real estate had another difficult year, although there were no losses, so it was flat for the year. But compared to equities, that was clearly disappointing. And now that valuations have adjusted, there could be more buyers coming back into the property sector. And if I look at the valuation of REITs, this may also start to look attractive. If I look at valuations, if I look at income they generate, so this could potentially be something for 2026. Private markets, specifically private equity, seems to look a little bit better. So private markets in general didn't outperform public markets last year. So we had that was probably the third year in a row where public markets did better than private markets. But we seem to be seeing light at the end of the tunnel in private equity for leveraged buyouts. There seem to be more IPOs. So there's a chance that the backlog of companies that are looking to be sold can be sold into the public markets. So 2026 may be a little bit better for this industry. Private credit was, how would I say, there was a lot of enthusiasm in private banks about private credit at the beginning of the year. But later in the year, there were all these discussions about data center financings by players like Blue Owl. Blue Owl was also criticized for marketing themselves to affluent investors. So the picture has changed a little bit. And if you ask me, the valuations or let's say the expected yields of some of these private credit products do not impress me. The fact that it's not as liquid as high yield and so on makes me wonder if it's something we need to invest in. We have some clients who like it, who do invest in it, but it's not something that I tend to include in my investment proposals. If we're looking at commodities, the story is quite different. Especially precious metals and gold had a fantastic run. This time around, it wasn't only gold, it was also silver and platinum and all other precious metals. Clearly, there's a kind of, the combination is rebalancing out of the US, and there's also the debasement discussion. So investors are looking for alternatives, investors are looking to diversify, and precious metals clearly benefited. The same goes for copper. Copper is widely considered the metal that will determine the clean energy future. Supply is limited, demand is high, so prices have to go up. And we've seen very positive price movement also in copper, as well as the mining shares. Mining shares have done extremely well, gold mining shares and copper mining shares. All of these are available via indexes, ETFs, and we do include these in client portfolios, and we like it because valuations are still attractive if you ask me. And regardless of where the price exactly goes, we know gold and copper should be well supported, so the companies investing in the sector should do well, and they've done exceptionally well last year. So I'd like to caution people not to assume similar returns in 2026. The other commodities, energy and agriculture, are, if you ask me, not so interesting from a private investor's perspective. Yes, there are some ETPs we could consider and some futures, but it doesn't really add value to a traditional portfolio. So I would say if you're looking at adding commodities, do it either in a very diversified way via indices. There's also a very good manager, which we like, which we include for clients who like commodities. But agriculture commodities as ETP hasn't really worked on a standalone basis, and the same goes for energy. So if you like these, maybe you rather look at the energy stocks. In our portfolio construction, we tend to emphasize three philosophies. Naturally, each individual, each family is different, and everybody has a certain appetite for the market or lack thereof, which is why we try to highlight three strategies where we know they've actually worked in the past and we have good confidence that they will continue to work in future, which is the traditional indexing, typically associated with Jack Bogle, the founder of Vanguard. That means you just try to mimic the market. You don't think about what's going to go up, what's going to go down. You just buy the so-called haystack. Try not to pay much for the vehicle that you choose to buy that haystack, and you leave it be. And this strategy is working very well. Initially, there was a lot of skepticism towards that when Jack Bogle launched it in the 70s, but it became truly popular in the 90s, and now a big chunk of the market is indexed. And we know it's working, and anybody who wants to continue to index is on the right path, and we wouldn't stop that. The second philosophy that we think is working well is the so-called scientific investing or factor investing. That's typically associated with Farmer and French, Eugene Farmer and Ken French. Eugene Farmer even got a Nobel Prize for his efficient market theory. As I mentioned earlier, he's dissecting the market, or factor investors are dissecting the market according to the various factors, and they try to combine these factors in intelligent ways to generate outperformance vis-a-vis the traditional index. There are more and more indices, more and more portfolios available, investable portfolios at low prices. And we see that in certain segments, especially at times the quality factor has done very well in recent history, momentum has done very well, and in the past year value has done very well. So we're quite open to this. And given that all these ETFs, index funds are all available at low cost, we tend to include more and more of that into client portfolios. And last not least, that's the traditional stock picking and bond picking, mostly associated with Warren Buffett and Charlie Munger, but also supported by research from Hendrik Bessenbinder, who basically said that the index performance is largely attributable to a few stocks. So if you have the capacity to find these few stocks, you can outperform. Naturally, we know that there are only so many Warren Buffetts, but there are some Warren Buffett derivatives, let's call them this way. There are stock pickers and bond pickers that we admire. And since we're a fee-only multifamily office, that means we're not generating income by selling products and collecting retrocessions. We tend to give our clients access to the lowest cost versions of these stock picking and bond picking portfolios, which makes them only slightly more expensive than an ETF and an index fund. So there are some. So if I look at our advisory universe, it's about 70% index or factor index and 30% stock picking and bond picking. And it's working. It's working if you do it well. And I would say it's especially working well in the fixed income space and in the global equity space. I think it's important that you as an investor try to understand these philosophies and see what works best for you. Some of you may be just focusing on cost management. That means traditional indexing may be the one that you're most comfortable with. Then there are scientists out there who are very intrigued by scientific and factor investing. And I realized that some of the entrepreneurs that I talk to, they tend to like Warren Buffett the best. They have the ambition to outperform, and they want to know what's out there, not just only by the index. From our perspective, it doesn't really matter what the portfolio looks like. We just want this portfolio to work. So whether it's an index portfolio, a factor index portfolio, or an actively managed portfolio, or a combination thereof, we're more than happy to help to compile this. Maybe as a rule of thumb, we can say for money market vehicles, we tend to use ETFs and money market funds. For fixed income, we tend to use active managers. Many of the traditional investment grade bond indices, they're overweight in bad issuers, let's call it this way. If you're buying bonds, that means you're lending money and you want to be sure that you're getting your money back. And we're observing that systematic investing in fixed income as well as bond picking by the few good bond pickers is doing better, and we know many of them. Well, global equities, there are a few stock pickers which we like. That's 4 or 5 which are in our universe. But we're naturally also using the global indices such as MSCI All Country World Investable Market. In the US, we tend to do indexing because it's very hard to beat these very efficient indices. In Europe, there was a time when we found a fair bit of stock pickers, but in recent years, it's gotten ever more difficult to beat the Euro Stoxx 50. So we've started to index in Europe more so than in the past. In Asia and in emerging markets, we tend to find many good stock pickers. So we're working mostly with stock pickers. Even if in India, we're witnessing that the spread or the alpha generated by stock pickers is getting less than in the past. So over time, we may also do more indexing in Asia. In Latin America, the same. There are good indices, but there are also some very good stock pickers. Just to give you an idea how we tend to go about portfolio construction. Now, if we look at the building blocks that I just described, we can say that our safety investment building blocks, which are typically bond investments or a combination of very, very small equity allocation with investment grade bonds, they've all done really, really well. And especially in the money market space, investors could earn high interest rates. This was very refreshing, very different from recent history. If we're looking at bonds with normal duration, we can really say that the bond pickers have all outperformed the indices. If I compare the performance of, for example, PIMCO Income, which is very popular in the industry, with a simple global Bloomberg Global Bond Index product, the outperformance is significant. So we're very comfortable talking about this. But also important to know that our investors only pay 0.55% annual management fee for PIMCO Income and not 1.4%, which clients at private banks do. On the equity side, I would say indices have done very, very well. And the stock pickers typically did well, especially in the technology space. I'd like to emphasize this. There's a manager called Paul Wick. He works for Threadneedle, and he's been outperforming the NASDAQ 100 for many, many years. And last year, the outperformance was significant because the Magnificent Seven names didn't work so well. But he managed to compile a technology portfolio that was up 36%, which is 16% more than the NASDAQ. So yes, we like stock picking. The same also for Polar Biotech, which is a really, really good biotech fund together with Henderson Biotech. Where stock picking didn't work last year was in the global equity space. We have 2 managers that we have now dropped from our list. One is Fundsmith, one is Walter Scott. They've been underperforming now for 3 years in a row, and we just think we have to pull the plug because what we don't like about them is that they've proven to be quite stubborn. Yes, we don't want style drift. That means we don't want a manager who is a quality or quality plus manager to turn into a value manager. But there are different ways to deal with the environment. So if, for example, we're comparing those with some of the other managers that have done really, really well last year, such as Egerton or Fisher Global, we're really disappointed. And as we're fiduciaries, we need to make sure that our clients are getting the best possible idea. So we're switching out of Fundsmith and we're switching out of Walter Scott. It kind of makes my heart bleed because I think they're doing a great job fundamentally, but I guess they're not good enough anymore, and we have to look for alternatives. In addition to these building blocks, we're also using investable benchmarks. I always found that when I worked for private banks before, the private banks used a lot of benchmarks that are not investable. So they're very theoretical, and it would be very hard to measure a portfolio against such benchmarks. So that's why we have chosen investable benchmarks. They're from a provider called Dimensional Fund Advisors. These benchmarks contain pretty much all imaginable global bonds and global stocks. They're even more diversified on the equity side than the MSCI World Index family and the FTSE Russell Index family. They can be purchased for only 25 basis points. So I think they're a good benchmark. They're a good benchmark in that they are representative, and they're a good benchmark in that if our work isn't good enough, our community can just buy these and be happy. In addition, they're available in all imaginable currencies. Since we want to do a good job, we have to be able to beat such benchmarks, and typically we do. Yeah, if I look at these benchmarks, they've had a very good year in 25, which is not a surprise given that they reflect global markets. We've started to identify a few additional such benchmarks. If the investor is referenced in euro or sterling, there's a solution from Vanguard. And if you're euro-based, there are a few more for what we call the fair horizon yellow. So just talk to us and we can highlight these opportunities to you. It makes a lot of sense, but I'm glad to say that since we've been using them ever since we started our business, they've done very well, and we've been even outperforming them. So I would say we can rightly say or proudly say that what we do is working. What does that mean for 2026? As every year I say, I know that I know nothing, and that's a fact. I mean, had you told me the beginning of last year that 2025 would be such a great year, I would have probably not believed it, because the preceding years were already so strong, 23 and 24. But that's what it was. And again, I don't know what this year will bring. And it doesn't really matter. If you think about why do we invest, we typically invest to achieve stability in our financial planning, to stash away certain money. Other monies should be used in a more dynamic way to achieve higher returns. If that's the objective, we have all the tools that we need. Because if we invest, we need to know that saved money ideally maintains purchasing power. So it's important to know what is the interest rate on safe fixed income investments. We know that. On the equity side, we know that long-term returns are in the range of 6 to 8% for large companies and 7 to 10% for small companies. So we can look at the global equity universe, at individual regions, sectors, factors, countries, and we can then say whether the current valuations differ from these past performances or from these expectations, and then decide whether we want to engage in an investment or not, because we know the context. What's also important is central bank action. Central banks, as we know, are stable in Europe, cutting in the US, and potentially raising interest rates in Japan. So rising interest rates in Japan are potentially a negative, especially for holders of securities in Japan, and maybe for people who like to leverage with Japanese yen. But the fact that the US Fed is cutting and the ECB is stable is generally good for the market. What is bad for the market, such as what we've seen in 2022, if inflation jumps and central banks are forced to raise interest rates, that would be very bad, but we don't see that at the moment. Central bank action is also a function of inflation rates, so we can monitor the expected inflation rates in the short, medium, and long term. There are so-called break-even inflation rates, which we can see from the market. That's the price action of certain market segments. So we know what we need to know to build a portfolio. So let's just ignore the noise. Let's not worry about what Donald Trump is going to do next. He's doing a lot of things. Just look at what do we need to achieve, or what do you want to achieve, and in how far is the current context relevant for you. You can see from our reflection document, we have created a so-called high-rise chart where we display the current valuation of fixed income asset classes and also of equity asset classes, whether or not they're expensive or not. We've established a traffic light. So you can see if the light is green, that means it's good to go, it's cheap. If it's orange, it means yes, it's still okay. And if it's red, means not now, don't buy it. And that's why now we wouldn't buy the Nasdaq 100, because it's too far away from the long-term return expectations. Other markets are cheap, so we focus on the other markets. And I think what's important is also, we could see last year the great development of the MSCI World Value Index shows it pays to buy cheap. I know a lot of the value investors had a rough time, but if you allowed yourself to buy cheap, you've done really, really well last year. And if we compare the various factors over the last 5 years, value has done also well. So maybe it's really in recovery mode. So what I would advocate is, whatever you do, Take a very close look at what your cash flows are like. Have a think about when you need to spend what kind of money. That means if you need to spend the money soon, don't invest it in risky assets. Keep it in money market investments. If you know you don't need that money for at least 15 years, put it into equity risk because that's where you get the highest returns. And everything else is in between. And this is why we created the so-called fair horizon concept. That means up to 2 years, we'd only stay in the money market fund. If you needed your money between 2 and 4 years, put it into investment grade bonds, about 80%, but add 20% of equities. If you don't need your money, you really know you don't need your money for 4 to 7 years, put 40% equities to 60% investment grade bonds, safe bonds. If you don't need it for 7 to 10 years, use the traditional 60-40 portfolio, which means 60% stocks, 40% bonds. If you know you can stash it away for at least 10 years, but maybe not much longer, use 80-20. That means 80% equities, 20% bonds. And if you know, yeah, like what I said, for the ultra long term, just go into equity, potentially private equity, potentially venture capital. We have actually come across some really interesting solutions in venture capital, which is a bit unusual because we're skeptics, but we found some things that are working for us and we've introduced it to the community. Then it's also often good to look at the losers of a previous year. Yeah, if we're looking at the valuations of private equity companies, we're looking at healthcare, we're looking at REITs, we're looking at the factor index. As we believe in them in the long haul, but they've done badly last year, this may be a time to look at those, add them to your portfolio. If you're skeptical about technology, maybe these are areas that you can start. Yeah, start with the cheap assets, and the high-rise chart with the traffic light can help you. Commodities is something that is being talked about on and off. I would say, given the dramatically changed global context, given the comparisons, I wouldn't say similarities with the 1970s, it's probably okay to add commodities to your portfolio. We have some broad-based solutions. One is a very good ETP from iShares. The other one is a great fund from Wellington. But I would say don't overdo it. Maybe do 10 to 15%. At this stage, I prefer maybe copper and gold mining shares to actually buying gold, silver, and these things, because we don't know if this rally will continue, but we know that these prices are well supported. So even if prices go sideways, these copper mining and silver and gold mining companies will do very well because they produce a lot of cash flow. Another area that keeps on coming up is clean energy. And I know that in the community, there are a lot of people who are concerned with the future. They want to invest in clean energy. And some of the vehicles and some of the single stocks that have been purchased are just bad. So I'd like to highlight to you an ETF, which is called GRID, G-R-I-D. It's a selection of companies that are highly profitable, that are global market leaders in the energy systems. The reason why I bring it up is it's been outperforming the MSCI World All Country IMI Index for many, many years. So adding this to a portfolio, if you're concerned with the environment or if you see opportunities in that space, I suggest you buy this GRID ETF rather than select single stocks. If you really want to buy technology, and I don't blame you for that, I also like technology, then I would say look at CT Global Technology. I'm quite happy that I managed to meet Paul Wick, the manager, this past year. We had a high tea event in Singapore, and I'm truly convinced that he knows what he's doing. He's been doing stock picking in the tech sector since the mid-90s. So he's gone through the tech bubble, he's seen the recovery, and he's still standing, and he is outperforming, and I'm impressed. So let's put more money to Paul Wick from CT Global Technology. In general, or to come to a conclusion, the world sounds very dynamic, sounds scary, but if I read history books, it's always been scary, it's always been dynamic. So our times are exciting, but probably not very different from the past. So if you wonder whether your portfolio is ready for Donald Trump, is ready for Putin, is ready for Xi Jinping, don't hesitate to reach out to us. Show us your portfolios, show us your current situation, and I'm sure we can help you. Yeah, that leads me to wish you a wonderful 2026. Stay healthy. I hope we're going to see peace in Ukraine, but we should also not forget about the other war areas that nobody's really talking about. There should be peace for everybody in this world. And let's hope we get a bit more peace in 2026. To good health, peace, and great investment returns. Yours, Mario Becker.